responding a little bit this morning. Jio Finance, Infi. On the other end, you got Bharti, as Vivek was just telling us. Nestle and Bajaj Finance are the others which are down, but more up than down, clearly. And you got about 60 odd points on the Nifty to show for it. Surbhi.
That Sierra launch was such a talking point around me, and I'm sure around the city as well. And can it really reverse the fortunes for Tata Motors passenger vehicles? It is a domestic business. It's one of the biggest underperforming stocks of the year, down 50%. But today it's up 1.5%, with some positivity definitely rubbing off. The other stocks, JSW Steel, Nigel was just discussing this with the analysts. Will there be another safeguard duty or some more protectionist measures? That seems to be the hope. 1.5% up on that stock as well. Tata Steel is also up about 1%. Coal India is up about 0.7%. Then there's IT, which is contributing nicely this morning. Names like Tech Mahindra, HCL Tech, and even Infosys, all of them putting on 0.5% to about 1%. Banks are not bad. The Bank Nifty is actually leading the Nifty. The gain is almost 0.4% on the Bank Nifty. So look at SBI, ICICI Bank. These are the early leaders at this point in time. On the flip side, not too many stocks to really worry about. Bharti Airtel with the block trades happening, down 2.5%. Tata Consumer and BEL. But otherwise, the Nifty is on a nice rebound note, 25,950.
Well, that's right, Surbhi. Good amount of, good move is what we're seeing on the Nifty. And the breadth of the market, actually, after a while, it's looking pretty okay. And hopefully, by the time we end, we'll have so many stocks that are advancing. You have 2.5 stocks that are advancing for one stock that's declined. We haven't seen that in a while. A few stocks that are catching your attention. Capillary Technologies, the newly listed company. This week, the stock is up 25%. Yes, that's correct. It's up 5% today, and that takes the gain for the week to 25%. The other big mover is Tourism Finance. A lot of talk about that investor that's gone ahead and bought a large chunk in Karnataka Bank. And in fact, he has a big chunk in, Tourism Finance as well. So for the week, the stock is up close to around 10%. Good move is what we're seeing out there. SAIL had pulled back 10% from the recent peak. And that one's back in the green, up close to around 3% as we speak. So good move, and volume's fairly okay as well. Another stock that got crushed last week was Sammaan Capital. That one, in fact, is up close to around 2.5%. So starting off with some green. Otherwise, some of these stocks, whether you're looking at Hindustan Copper or Nalco as well, they saw a big correction when there was that, a bit of uncertainty with regard to a Fed rate cut. Last week, the probability had fallen to as low as 30%. It's back up to around 80%. So some of these metal stocks are celebrating on that front. The trade that we're waiting by for, the Bharti Airtel, that has taken place. Stock down 2.5%. Once the block gets out of the way, let's see if there's a recovery inside. And Karnataka Bank as well, cooling off. Stock is up, I think, 20% in the last 7 sessions. That one's down 1.5%. Let's see whether it stays in the red or it sees a bit of recovery.
That block has gone through, right? So 2.5% lower on Bharti, 3.5 crore shares, 0.6% equity, worth 7,400 crores. And that, of course, is the big one this morning, which Vivek, of course, has been telling us about from this morning. So there you go, that block going through. Well, I think we have Harish Krishnan now joining us to take us through what he's been doing at Birla, right? Co-CIO and head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good to have you with us here. Thank you for joining us. We are perhaps going into, at least the mood seems to be a bit despondent when whoever you speak with. Not enough impulse for the market to come off in a meaningful way, and not enough to take it up in a meaningful way either, across the board. So what does one do? I mean, it seemed to be in a bit of a holding pattern environment across indices and maybe even some stocks.
Right, Prashant. So, close to almost all-time highs of the indices. I think this question pretty much sums up the mood of the street, because the median stock is smarting a very sharp drawdown and is nowhere close to the all-time highs that we're seeing of, say, the Nifty or the large cap indices. So I think it's more a function of the breadth of the market and the fact that over the course of the last 2-3 years, a lot of money has chased down illiquid names, be it in the micro caps, small caps, that are all smarting from, drawdowns. So Per se, I think, we are more in the optimistic camp. We believe that earnings growth is actually starting to move up. We did have a view that come the festive season, there will be an improvement in earnings growth. The last quarter did seem to suggest an improving in the breadth of the earnings growth. And we do think that as we get into the December and the March quarter, this will further get bolstered by a percentage or two. So as far as earnings is concerned, it's quite good. I think what plagues the broader market is also a function of significant amount of supply of paper that seems to be incessantly coming, both in the form of IPOs, wherein we've seen some very large IPO transactions from September, October, but even so in the form of various stake sale, be it by promoter groups or by private equity and venture capital. So that kind of puts a lid. Just to give you a perspective in terms of numbers out there, current supply of paper is close to about 2% of market cap on an annualized basis. This amount of paper we have never seen. The last time we saw something even remotely close to this was in 2017 end. So that gives really the problem point at this point of time is not so much about the earnings growth or fundamental stacking up, of which we think there is a lot of good things in place, but more a function of the incessant supply that's around here.
Okay, Harish, hi. Great to be speaking with you this morning. Thanks for joining in. So, what's really interesting, I think, since our last conversation is that a lot of brokers have started giving buy calls on IT. I don't know whether we can call them contrarian buy calls any longer, because a couple of them are giving those buy calls now. And I think the thesis really is that at some point, we'll be past the build-out stage of AI and we'll be in the adoption stage. And that's the argument that some of the brokers are making, sell-side brokers, that Indian IT services companies have always been very good at adopting new technology, whether it was cloud or whether it was digital. So they'll do the same with AI. And therefore, we're probably past the worst. Does that argument cut ice with you?
Absolutely. In fact, we've been positive on IT services for the last 3 months or so. In fact, I do remember coming on to your Diwali show, and there were a lot of raised eyebrows at that point of time as to why we're looking at IT services as a potential dark horse trade. And our point was not so much that, we ever had a doubt that Indian IT services would adapt, because we've seen them adapt through various changes over the course of the last almost 3 decades. But more importantly, the real recipe for making money in markets is to buy at low expectations. That really is the longevity of a cycle in a good business with very capable management teams. When expectations are low is when there is a greater probability and an asymmetric nature of making money comes through. So just to give you our thesis as to why we believe IT services were a buy was primarily that over the course of the last 3 decades, there have been only 3 points in time where the market cap share of Indian IT services, which is the market cap of Indian IT divided by the top 1,000 companies market cap, has been lower than the profit pool share of Indian IT services. There have been only 3 instances. The first instance was in 2008, amidst the global financial crisis, wherein the banks themselves were going belly up, and therefore, given that banks were the largest clients for Indian IT services, there was worry on Indian IT services existence. Second was in 2017, when there was a similar wave of digital ecosystems springing up, and there were worries that, Indian IT will not be able to adapt. And now comes the third kind phase. Now, just because it is lower doesn't mean that, in the next 3 months, 6 months, it's going to surprise on a massive positive scale. But we do think that the risk reward is significantly in our favor when we think about from that perspective of Indian IT services. So that lies our base thesis. The second, of course, was the fact that we do think that, given rupee depreciation that we've seen from 82 to 88, 89, there is some amount of margin support of Indian IT services. And lastly, like I said, the expectations are way too low, which we think over a 3-year perspective provides us reasonable room for comfort.
All right, hi, Harish. Good morning. Good to see you in. If you're allocating money, though, what would it be? Because the broader markets are not feeling like anything like all-time highs, right? The kind of pressure that you're seeing, if you speak it to anyone, they'll be like, my portfolio is down, whatever, 5, 10, 15, 20% as well, depending on the quality of the stocks that they have, obviously. While we are talking about 1-2% away from fresh all-time highs. Do you think it's time now that if the economy is going to recover, earnings are coming about as well? And last quarter's earnings haven't been too bad, actually. it's time actually for the broader markets to participate?
So we are constructive on markets. It's just that the nature of the markets, instead of looking at it only from the dimension of going down the market cap curve, which is that small caps will give greater returns than mid caps, greater than large caps. I think what we are likely to witness is possibly a greater direction of sectors that are going to lead the next 3-5 years of the markets. By that, what I mean is that there are at least, in our opinion, 8 or 9 key sectors which account for about 50% of profit pool of India, which have underperformed in the last 3-5 years. And that to us provides us an opportunity. Just to give you some examples of certain sectors out there. So if you think of chemicals as a space, this is a space that has underperformed despite significant amount of capex. Of course, there are global headwinds in the form of destocking, etc. But this is a space where we are increasingly positive. Similarly, if you look at insurance, that's again a space which hasn't done anything over the last 3-5 years. Almost 5 years or pre-COVID, every corporate wanted to be in insurance. Today, pretty much most of them are getting out, and the big three or the big five are really consolidating away market share. It's not that the demand penetration story ever went. It's just that through a cycle when we were to look through, I think now we are getting to a phase where expectations are quite low, and they are quite possibly likely to beat up. Similarly, if you look at, say, cement, if you look at, say, metals, if you look at IT services that we spoke about, or even the banking sector, especially on the private banking space, there are a lot of these pockets which to our mind provide us reasonable value and reasonable margin of safety. Of course, nothing is very, very cheap, but in the context of where, as you rightly put out, earnings is likely to start tracking upwards, and the fact that these, in aggregate, if you were to look at it, these 8 or 9 sectors account for only about 40% of the total ownership by various funds. That means that this is an under-owned space, this is underperformed, and that there are tailwinds coming through in the form of earning catalyst, which we think is a heady combination as to where money can eventually go towards, and which is where I think instead of looking only from a breadth, from a small cap, micro cap, etc., participating, I think we think that it makes sense to look at it from a slightly more vantage point of sectors, and these are the sectors that we are allocating more of capital to.
I want to ask you about platform businesses, and perhaps the most profitable of them, exchange businesses. Not too many of them listed. MCX, by the way, there was a flash at the bottom of the screen that MCX has crossed 10,000 rupees price for the first time. In a rare appearance, we had the new MC, not so new, but relatively new managing director at MCX with us. She spoke with my colleague Manisha Gupta. I want to just play out a quick soundbite. These are basically ambitions that she set for herself and the organization. So just listen in, and I'll come back to Harish with a question.
What I heard is, you have to be ready for 10x, right? And I think that was really a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x, and we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single shot jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months as a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
Harish, we look at, growth in 26, 27, will it be 15, will it be 20? But when you are, when the management says, well, okay, 10x growth, how do you read it as a fund manager? So 50,000 crore market cap, they'll probably do about 1,200 crores in profits. So about 40 times, 45 times earnings this year. Your thoughts on MCX and maybe other these kind of other businesses as well?
No, so I think we are very encouraged by platform businesses and their potential for operating leverage. Now, the key is where they are in a cycle. So we've seen, for example, the stock market cycle over the course of the last 5 years where volumes have shot up through the roof, be it especially on the F&O side and a bit on the cash volumes. And can we see something similar to happen on commodities as more and more Indians discover this kind of a trade? I mean, there are a lot of new age broking platforms which have just started introducing commodities for investors to trade on. We per se are quite positive on commodities as a space, given the fact of global geopolitics and the fact that pretty much all major economies want to have some amount of resource independence. We do think that that is going to lead to an improving commodity prices as an overall basket. So I would think that, there are these platforms that are looking quite interesting. The key aspect for us, like I said, is that how do we think about how much of it is already priced in and where are we in the cycle? And from that perspective, there are a lot of platform and new age companies which are just about, as they say in their parlance, getting into day zero or maybe into day one. Those are the ones that really interest us because unit economics for many of them are actually looking extremely good. There is very little competition in many of them. And therefore, we do think that, they can have a tremendous runway if one is able to get a good entry price into many of these franchises.
Okay. All right, Harish, I think on that note, we'll wrap it up. Thank you so much for joining in. Great conversation as always, good perspective and some interesting calls there coming through on IT as well. We'll keep that in mind. So, of course, Harish Krishnan there turning quite positive. I mean, that's Aditya Birla Sun Life Mutual Fund as a house turning fairly optimistic on IT services. We'll get to our next guest in just a second. Let's just quickly take stock of where we are. The market right now is cruising along quite nicely, recovering from yesterday's drubbing. 105 points higher, so it's not looking bad. Banks are actually doing very well, and so are mid-caps this morning.
Prashant, you asked a question with regard to air purifiers market, right?
We're back to the purifiers.
No. I mean, in terms of financials, the market size is 230 crores odd. That's as of 2023, and it's expected to grow at a CAGR of around 18%. By 2030, it should be at around 750 crores odd.
Annually.
Annually. In terms of a listed player, Eureka Forbes, I think, is low single digits as a percentage contribution, and the others are very, very small in revenue terms. But the market is, the penetration is less than 1% for air purifiers. So it could be a market that could actually explode.
The EMS players, as of now, the big EMS players.
Dixon has a tie-up, I think, with regard to it. That's just pulling out some technical research, and Havells.
It's just too small.
Too small,
because, and think about it. When does demand spike? It basically spikes during crisis.
Yes.
Yeah.
When you're hit by smog, pollution, headlines, right? I mean, I think October to December perhaps is peak, and then it kind of tapers off once again. So very, very small right now, of course, and also aimed at basically upper middle class and that category of consumers. It's not a mass product in that sense, so to speak. Well, just a quick couple of words, a couple of stocks basically. Capillary, right? We highlighted this in the morning with Devin. And then Hormuz had some data on this one. It's a recent listing, 4 days old in the market, 786% once again. It's the number one volume-led gainer at this point. I think came to the market at about 520 or so, I think was where it listed. I'm not sure the IPO price, but 780 now. And huge volumes. Sammaan Capital is coming up. It's the number two volume-led gainer this morning. Sammaan, of course, has had a big fall from, fell from 190 to 150 very quickly. It's back at about 160 right now. Number two volume-led gainer on the NSE. SAIL, Steel Authority of India. We were talking about steel with the steel secretary and with the analyst this morning. 4% on SAIL, 138. Big volumes. Doesn't come up at the top of the volume list, but it is this morning. There's Tata Investment Corporation, which basically is an investment company. It had this frenetic move higher. Just one-way move. Went up to about 1,200 rupees. From 1,200, basically fell to about 700, and it's now almost 800 right now. So that is Tata Investment Corp. What else? You've got Reliance Power, which is coming up with some volumes. Bombed out name, 38, 39 rupees. Fino Payment Bank is another one. What's happening here? So closed yesterday at 266. It's up 30 rupees right now. Fino Payment. And look at the volumes, almost 2 million shares on Fino Payment Bank at this stage. I was talking about GE Vernova yesterday. Again, I mean, of course, it's done phenomenally well. Last 3 months, it's kind of been flat, but 29.45 on GE Vernova. LG Equipment, we highlighted how SBI Mutual Fund has picked up a stake, 4.5% here. So it's coming up. Tarsons is another one, right? So fell for a while. And then you had a big recovery yesterday. There was a clean-out trade. I think it was part of Nimesh's chatter list as well. Tarsons will come up. It's up another 5% this morning. So there is enough and more action in terms of single stocks, individual names out there. That's the one I'm talking about. Look at volumes come up as well. But I think we've got our first corporate on the show, post-market open, that is. Shriram Finance. Surabhi.
Yeah, absolutely. Plenty to talk about, as always. And we have Mr. Revankar joining in, Executive Vice Chairman of Shriram Finance. We need to, of course, discuss a lot of the points in the business in the second half. We need to understand how margins are looking because Mr. Revankar has been telling us that maybe second half won't be as bad. I mean, margins may be inching higher. We'll discuss the AUM growth prospects as well and whether they're looking to increase their guidance. And, of course, whether the company is well capitalized at this point to support growth. Mr. Revankar, good morning, sir. Great to have you in. Now, I have to start with that third question. And I know we've asked you this in the past, but you please bear with me because the market excitement and speculation refuses to die down, sir. So can you set the record straight on whether Shriram Finance right now at this point in time is in any sort of discussion for raising capital? About 3 weeks back, there was a lot of chatter around a Japanese entity that Mitsubishi UFJ will perhaps put in as much as 20% or will buy as much as 20%. Can you just set the record straight, sir, on this?
There is no further change in the information that I can give you right now. So I don't think there is anything to talk about it now.
No, but are there any conversations ongoing, sir, with any entity with respect to any sort of an equity tie-up or any sort of an equity deal?
See, there will be many discussions going on. I cannot be talking about it. So there will be always some interested party who are, as you are rightly putting it, India is attracting a lot of capital, both for the debt and the equity. Everyone is seeing India as a large economy growing well. So that is where the interest levels are very high. And that is likely to continue.
Mr. Revankar,
just a point on this. Now, what you've said is that discussions are always underway, but you're not giving us anything specific at this point in time. And obviously, foreign entities are showing a lot of interest. Middle Eastern entities, Japanese financial giants have shown already interest. But can you tell us whether Shriram Finance at this point in time wants to raise more capital? Are you looking for an equity partner?
See, we are at 20% plus on CRAR, so we don't really need capital for the growth. Whatever for the growth required for next couple of years, we have sufficient capital. So I can't disclose beyond that.
All right, Mr. Revankar, good morning. Good to see you in. Everyone's talking about, this deal. But just to get some clarity, the last time you said there could be multiple discussions that are taking place, but not a concrete plan. So there are still multiple discussions taking place?
See, as a NBFC or a bank, you always need to look for raising capital, both equity and the debt. So that will continue to be there. So it is not one-off event for the NBFC or bank. So this is a raw material for us. So that will continue to be there.
You know, the analyst community believes that Shriram Finance trades at around ballpark 2.1, 2.2 times or thereabouts on the forward basis. One of your competitors, Chola, for example, trades at 4.5 times. Don't you think it'll be a perfect blend? You know, you get a good foreign investor coming in there and there could be a re-rating of sorts. Has the thought come to your mind, sir?
I think you're acting as an investment banker. So there are a sufficient number of investment bankers who are coming with various ideas.
Okay. All right.
But you're talking. So we go back to where we were 2-3 weeks back when we spoke to you. Shriram Finance is in discussions for potential equity fundraise, but nothing concrete as of now.
So as I was telling you, we have been talking for a long time, not now.
Okay.
So,
Okay.
And do you think a deal you're reaching, I mean, there's progress with regard to these conversations?
nothing to comment right now.
Okay, all right. Let's leave it at that then. But the street believes, if you go to most of the conferences, the buzz is very, very high with regard to Shriram Finance and a possible deal that's going to be in the works. Let's track business then. How has growth been? If you could help us out, with regard to the CV space. What's the outlook out here for the year? Just revise the growth target. And I think you were talking about NIMs improving as well for the latter part of the year. So let's revise both those two numbers first.
Yeah, definitely, yes. The October was a big month and there was a lot of activity. The most pleasant part of it was the demand coming from the rural market. So the rural market is actually, the demand is much faster than the urban right now. And I believe with the government now have cleared some of the infrastructure project in the last cabinet meeting, there will be a much bigger thrust on the infrastructure part of it. And that will help the growth coming back in the urban area also. So both an urban and rural put together, the demand should be much higher. So we believe the growth can be much higher than the guidance given. We gave the guidance of 15%. We should be growing at around 17-18% if everything falls in line.
Gautam, Mr. Javankar, good morning, sir. Thanks very much. I mean, I think a masterclass in answering, not answering questions, but I think it's also fair, right? You're always talking, NBFC always needs capital, so that is there. We'll wait for the deal when it finally happens. I just want to ask you, what is the liquidity situation, if you will? There is some buzz that the RBI would perhaps. It's a strange kind of situation. The RBI and one thought that there's ample liquidity, but then there is talk that maybe RBI may come back with OMOs, may need to do OMOs, etc. Just your thoughts, sir.
The liquidity is quite comfortable right now, but yes, the NBFC industry do feel that there is a challenge on liquidity to them. So, because especially smaller NBFCs in our meetings, association meetings, they keep raising the issue and they want to have some kind of a refinancing arrangement for them so that the business can be smooth. Because everyone wants to have a growth at a particular rate. So, the continuous supply of the credit is important for the NBFCs to continue to grow their business. So in that way, yes, they need to look at a different liquidity or different way of borrowing other than the bank. That is something which we have been debating. Otherwise, I feel the liquidity is comfortable. We are able to raise resources and the interest rates also are improving in the sense we are able to raise at maybe around 20 basis points lower than the previous quarter. So that is a positive step.
Incremental cost of borrowing is 8.3%, sir?
Yeah, now it's around 8.15. It has come down.
Okay, and you're on record, I think you told us this earlier as well, that you aim to bring this lower through a couple of initiatives. Yeah, and that this may go back to the first question about deal, etc. as well. Who knows? It could be all. It could all be tied as well. Now two specific areas. CV loan growth, you were expecting it to be a little ranged, and on MSME, you seem to be indicating that you're going slow on growth there, at least for the next few quarters. Could you talk to us about both?
Yeah, MSME, yes. I have been talking to few of the industry association and also to some of the customers to understand what is the actual impact, because some of the industries which have direct exposure to US, they have slowed down, but some are also looking at new markets, and people are now looking at Asia market and Europe market to diversify their overall export market, and that's a good thing that our people are able to start looking at the newer market and keep growing. Meanwhile, domestic demand is very good. So maybe because of the festive demand, the October, most of the MSME segment, they had a full book order, and maybe the November end we should know. But November looks like the numbers as of now that year on year it is flat. And of course, October to November, we can't compare. The year on year is flat, it's not really grown much. So we need to really wait till the quarter end to see the full results.
So MSME growth, November to last November is flat, you're saying, so far?
Yes, overall, their sales and their turnover.
Okay. All right. Just a quick word on MSME, sir. As a percentage of your book, I think it's around 15%. Could you give us some more clarity? How much of the MSME book is exposed to the export sector? And how is the asset quality faring?
It is hardly anything, very small, because we have been focusing on small ticket.
Okay.
We have never been lending to the mid corporate, like 100 crore plus. We have never done any such lending. So our exposure is small, very small. Out of 15%, maybe 10% of 15%, there's 1.5% of my book should be with the export linked the MSME. That's all.
All right. And ROA exit rate for the year should be approximately 3%?
Yes, we always aim at 3%. We are at around 2.8 now. We should be inching towards 3% by the year end.
Okay. All right, so we'll leave it on that note. Thank you very much for joining in. Always a pleasure speaking with you. And thank you very much for giving us more clarity on how business is shaping up and how the second half is, which perhaps is going to be even better than the first one. We'll take a break on that note, come back on the other side, and we'll have the management of Brigade Enterprises joining in. We'll look at the demand trends in the real estate sector.
Welcome back. This is Corporate Radar. Quick check on the markets. Well, we are at the high point of the day. December has started off on a good note. We're up 180 points or thereabouts. The bulls will want to end 2025 with a flourish, and the start of the December series has been quite good. That said, let's turn our attention to the real estate space. We have Pavitra Shankar, the MD at Brigade Group, who joins us. Hi, Pavitra. Good morning. Always a pleasure having you on the show. Thanks a lot for joining in. Well, let's focus on a couple of numbers then. I think for the year, in terms of pre-sales growth, you're targeting around 15 to 20% for FY26. What makes you so confident? Because the first half of the year, I think it's low single digits, 3% or thereabouts. So are you confident you get to that mark of 15, 20%? And also give us a sense about what is the contribution coming in from, of sales coming in from new launches?
Hi. So what is happening this year is, I would say, fairly similar to the last few years, where our contribution from new launches is quite heavy in terms of the overall target and therefore achievement as well. This year, in the first half of the year, we have done about maybe 40% of what we would like to do for the annual target. And I would say that's in line with what has happened over the last couple of years. So typically the approvals, launches tend to get pushed a bit, and we tend to see a lot of large launches coming in the second half of the year, not just with us, but with some of the other listed players as well. So we're making sure that all of our approvals are, being tightly monitored, and whether it is in Bangalore or Chennai or Hyderabad, which are all our markets of focus, our teams are geared up to do that. In terms of demand on ground, it is still very good. Our portfolio is skewing more in terms of premium inventory, which is where the market has been showing a lot of demand of late. And our new launches are reflecting that, as well as some contribution from mid-segment as well. So I think overall the launch outlook is good. It's a matter of getting the approvals in time. And once the launches happen, they are generally seeing pretty good response on ground.
So you're sticking to the 15-20% growth, right? Pre-sales growth.
We would like to do that. As I said, again, it's dependent on the launches happening in time and getting RERA in time so that we can actually take the bookings into this financial year, since we are looking at it on an annual fiscal year basis. But on ground per se, if it slips into this quarter or that, nothing is impacting the demand situation. But naturally, on the numbers basis, we need to make sure that it enters into this financial year.
And out of the sales that you've done, how much is coming from new launches as a percentage?
Around 40% has come from new launches based on the launches that we've had in the first half of the year. Some of it was also very high-end inventory. So based on that, we've had about 40% of our numbers come from new launches.
All right. Pavitra, the other point, we get back to your financials and the way you see your business shape up. But what came over the weekend was the new labor law codes, right? And that could have some impact in terms of cost. For you as a company, how do you see it impacted, in terms of employee cost? How much does it go up by? Point number one. And as a percentage of the total development cost, what would it be? I think most industry experts were suggesting low single digits increase. Your take?
So we're yet to go through in full detail in terms of what actually comes through and study that. For us, the labor cost or the labor code changes impact not just on the corporate side, but also on construction labor. So we're still going through that and understanding what the full implication would be. But overall, I think the reaction so far has been a positive one in terms of how things will get simplified as well. So we're looking forward to it.
Pavitra, hi. Good morning. A slightly broader question, and it's great that we have you today, because in the morning I was going through a note that one of the brokers wrote, Nuvama. We're talking about over pan-India position. I think this is a question that's being increasingly asked. Whether the real estate boom cycle is entering a midlife consolidation phase. And the numbers that Nuvama put out, year-to-date CY25, sales value is up 6%. This is pan-India numbers. Launches are down 6%. And again, CY25 sales overall are down 13%. Launch volumes are down 10%. And therefore the question, I'm just placing the numbers for context. In your core market, in Karnataka, in Bengaluru, are you seeing any signs of this mid-cycle slowdown?
First of all, I think I prefer the word consolidation as opposed to slowdown. We've seen a fantastic ramp up, I think more than anyone could have even dreamed or imagined, supported by the best of conditions, including interest rate, demand from customers, all of that, and structural growth in the sector and overall economy. We have seen a huge ramp up also in terms of prices. Again, specifically in Bangalore, since you've asked me, prices in our own portfolio has more than doubled. It's a mix of like to like as well as product shift as well. So I think overall the premium and high-end segment have seen a lot of demand already, and that is where we see things stabilizing. Naturally, once ticket sizes go from 1.5 to 3 crores plus, you do see that demand consolidating. It is still there. But in terms of expecting a premium project where all the ticket size is 3 crore plus to sell out within the first month, those I would say are irrational expectations, and also that's not happening on ground today. So we are seeing that kind of stabilization happen in the premium segment, but mid segment is still extremely healthy. Those launches are doing really well. So I think overall it is a matter of developers also readjusting what the product portfolio is going out today in terms of the design brief and so on to our teams, and understanding the kind of demand on ground.
Yeah.
So it's still very good. Pricing has doubled. I mean, we hear that every day. So that is a challenge for us to expect the same kind of absorption with those pricing levels. But overall, I'd say the market is still doing very well. We're very confident of launches, especially in the mid segment and the slightly, mid, what I would call the premium sector. But expecting things to sell out in the first month is difficult to continue.
Maybe we're past that, that stage of the cycle. So what you're saying is interesting, that, that maybe on the pricing front, things are moving towards consolidation, especially in the super premium segment. So this outlook that you've just given us, 15 to 20% growth in pre-sales, this growth will largely be a function of higher volume. Would that be safe to assume, rather than any major pricing spurts? And if you could just break down the pricing trends between, whether there's consolidation at the premium end, whether in the mid-market segment, whether you still see scope for price increases?
See, I think overall the pricing expectation of what happens at launch through the life cycle of the project is pretty much stabilized. Whether you are looking at mid-segment or premium, it's not in a price discovery phase for a developer, which is what it was in the last couple of years. More so like 2 years ago, when we would launch a project and then not realize that the demand was there and people were willing to pay that much more. So overall, I would say regardless of what product is being launched, everyone has a good understanding, that is to say the customer and the developer, in terms of what pricing one should expect. So I don't see a double-digit kind of increase going forward in terms of pricing. Therefore, for all of us, I would say the numbers would come from overall volume of launches and total inventory that we're able to launch and sell, rather than huge price jumps.
Okay. Quick final question, Pavitra, in terms of just the kind of money that you'll put to work into the second half of this year and going into next year, because you have a lot of launches on the office side planned as well. So just leave us with some ballpark numbers in terms of, the investments, whether it is land acquisition or some of the office side build-outs that you'll be undertaking.
Yeah, so, on an annual basis, we've been spending upwards of 1,500 crores on land acquisition. It's a combination of across all our sectors, so residential, office, hotel as well, but predominantly residential and office. And it's a mix of joint development as well as outright purchases. We expect to see that number continue to increase, because despite the consolidation, we are still very bullish on the market and still intend to be aggressive in terms of acquiring land in our markets of focus. In terms of the office and in terms of our office capex, we have about 1,700 crores of capex overall in terms of what is under construction, in which we have already spent about 700 crores or so another 1,200 crores to go in terms of our office portfolio, where we are under construction. Some of that will be for sale, but a lot of it will be for leasing.
Pavitra, so good to speak with you. Thank you very much for joining us and running us through the latest as far as Brigade and the environment you're operating in. Thank you. Well, I think the markets moved up, and how, right? 200 points on the Nifty. And that is the story, actually. It's a vertical 90-degree kind of sort of takeoff which has happened. And What's the time now? I think it's 10, right? Past 10, little past 10. 9:40, 9:42 is when the pickup started. We were at about 26,000. Basically, we were at 26,000. And in the last 15 minutes, another 80 points on top of what the market opened up with. So this is a very, very good looking screen. And it also means that we basically bounced exactly from the 20-day moving average. Yesterday, there was a touch of the 20-day moving average. And then the market closed just 15 points off it, above the 20-day. So you've hit that short-term important kind of moving average, and then you've bounced very, very sharply. The new listing at the bottom of the screen also is something I'd like to address. Excel Soft Technologies is listed, and it's listed at 135 rupees. They sold stock in the IPO at 120 rupees per share, and I'm sure we'll have the management come up a little later to talk to us about where they're seeing the outlook going forward. Steel is the story. If you look at the Nifty stocks, JSW Steel, and I highlighted SAIL in the broader space earlier with large volume-led gains. JSW Steel is up 3%. So 1,147 on JSW Steel is what you have. Number two is, I'm just looking at the Nifty stocks. Adani Ports is the number 2 position. You got Trent, which is up about 2.25%, and HDFC Life and Tata Motors Passenger Vehicles is up 2% each. So it's a pretty good-looking screen. Except, actually, on the Nifty, there is just one name, which is at the bottom of the screen, which is Bharti, which is down. Otherwise, it's a all-up kind of a day, at least as far as Nifty stocks go. Even in the broader markets, it's 4:1 advances to declines. So that has also picked up substantially. 2,000 up and about 550 stocks which are lower.
I think the market is undoing all the pain that we saw in the last 3 sessions, to be precise, because getting into an expiry day, sometimes you see some kind of adjustment. So all that is getting unbound, so we're back at around 26,100, and the breadth of the market, that is encouraging. As Prashant as well was talking about, towards the end of the year, there is some P&L protection that you're looking at. So there appears that a churn has taken place, and now hopefully, in fact, the broader markets as well want to participate, which will help portfolios feel good. And a word on the steel stocks, there is hope that safeguard duty will finally be imposed. And the second factor is now the street is a little bit more bullish with regard to getting a rate cut coming in from the Fed. And then hopefully the RBI as well has some headroom. When you see, the dollar index that was at 105 has come down to around 99.5. Softening of the dollar index is good for metal stocks. And that's why you're seeing the metal index
Nigel,
as well. That's up.
My indicator for India-US deal,
Gokul Das exports.
So it is not the India-US optimism because Gokul Das is flat. I mean, it's got nothing on it. It's up 0.15, so 925, while the markets sort of picked up quite a bit. So it looks like technical factors bounce off important level. There's a 20-day, etc., which is at play. Vinay Rajani is with us of HDFC Securities. Vinay, good to have you with us here. Good morning. What would you do, and how would you read? Would you trust this price action? And on the back of it, what we're seeing, where would you find trades?
Yeah, good morning and thanks for having me on the show. So definitely there has been a good development, and since morning we have seen a nice recovery. If we go by the couple of observation technically, as you said, rightly said, the 20 days exponential moving average has been a strong support. And the another observation is that today's low is exactly open is equal to today's low. That means the sentiment since morning is positive, and this we usually consider as a very positive sign and bullish development. So today's low is equal to today's open. That is another positive sign. And today's movement is almost engulfing the 2 days entire bearish movement. So that is also a positive sign. Global market is supporting very well, and the setup is quite good. Large caps are definitely performing well. The another development is that in the starting of the December derivative series, we have seen a FIS long to short ratio at 0.18. That means as of yesterday close, the FIS holding more than 85% short positions. That means in that case, we can expect a limited downside, and there is a good chances of short covering in the coming session. So that is also a supporting one. So overall, we feel that the Nifty is about to cross its all-time high, which was placed at 26,277, and go beyond that. We see resistance, positional resistance at 26,500, and very strong support is placed around 25,800, 700 zone. So even if we see an intraday correction during the day, that should be utilized to go long. And overall, we feel that Nifty is headed for the new all-time high, and 26,500 should be the target for the Nifty.
Okay, all right. Vinay, that's as far as the Nifty goes. What about individual stocks? What are your trades now?
So we have been bullish on PSU banks, and Bank Nifty as a whole has outperformed in the entire November series, and for last 3 consecutive series, Bank Nifty has been doing quite well, and there has been long build-up also at short. So SBI is one of the stock which is the largest PSU bank and looking quite strong and continuously into momentum. So around 990, 994, one can go long. 980 should be the trading stop loss on the upside. I'm expecting a target of 1020. The second stock I would pick from the two-wheeler space in the auto segment, Hero MotoCorp, which has also broken out on the long-term charts and looks like that after long underperformance in the two-wheeler space, now this stock has started outperformance with a higher momentum. So Hero MotoCorp can be bought around 6080, 5960 should be the trading stop loss on the upside. I'm expecting a target of 6265.
Okay, all right. We'll leave it there, Vinay. Thank you very much for all the trades. We have to take a quick break. On the other side, we'll have the commodity cues with Manisha Gupta.
Know this.
Welcome back. As promised, let's straight away head across to Manisha for the commodity cues of the morning. Manisha, what's the headline you're tracking?
Well, I'm looking at the agriculture commodities. You know, this has been a year when we haven't really bothered about agriculture as an inflation. That is because not just in India, but globally as well, we are looking at higher agriculture produce coming in. So a couple of commodities which actually have seen higher prices, but apart of that, everything else that comes under agriculture has seen a decline in sense of prices. I'll start with soybeans because you've seen prices gain up here, trading at near 16-month highs. And that is because the US weekly sales to China are at the highest since November 2023 there. But what the markets are looking at right now is that one, China already has high inventories. The crushing margins have been on the lower side, and the US soybean is not competitive when compared to Brazil soybean. So how much will China buy from US is a bit of a question mark, and that is where the rally is getting stalled right now. The other one is cotton. Hasn't had a great year, this one, but at this point in time is trading at a one-week highs, and that also because the US weekly export sales have doubled on a week-on-week basis, and markets now seem to be believing and giving an 80% probability of a US December rate cut by 25 basis points, and that clearly has been supportive for various asset classes, including agriculture, industrial commodities as well. What is not doing well into the markets is rubber, trading at a two-week low. The Chinese demand has been on the weaker side, and the European Union is right now delaying the deforestation regulations and perhaps revising it as well, and that is what has led to decline in prices. Palm is another one, trading at a 6-month lows right now. It's to do with the ringgit as a currency as well. But apart from that, the major producer of palm, which is Malaysia, is looking at the October output at the highest in last 10 years. And when you look at their inventories, they are the highest in 6.5 years as well. So there is no dearth of palm when it comes to Malaysia. Wheat is another one. India is looking at a very good crop, and so is everybody else in the global markets. So that is the reason you have wheat trading at a one-month lows, and the global inventories and global production are at a record highs. The other one is coffee, trading at a one-month lows yet again. US has removed 40% of tariffs from Brazil, but this is being done for green coffee and not for instant coffee, and that is what is bothering Brazil there. Also, if you look at the overall markets then in this year, you will see that barring a couple of agriculture commodities, everything else seems to be heading for a negative 2025. So as I said, soybean has done quite well, 13% of gains onto that one. Sunflower is up by 10% as well, and that is exactly where the gains stop. It's a 5% decline for rapeseed and 10% down for palm oil as well. That is what edible oil sector looks like. Now, this is what we're looking at in sense of grains and cereals. It's a decline across wheat, corn, and a 27% of decline for rice as well. Take a look at the industrial agriculture commodities, which comprises of rubber and cotton, and you're looking at a 12 to 10% of a decline here as well. And then comes coffee and sugar. So while coffee seems to have done quite well, up 29%, sugar in the international markets is down by 23% in this year.
All right, Manisha, thanks very much for that. So that's commodities in focus. We'll take a quick commercial break here. On the other side, it's our special segment is the economy. Lata in conversation with Manish Sabharwal of Teamlease, Somraj Roy of CEAT, Atul Gupta of Trilegal, and Amir Basole of Azim Premji University on the impact of the 4 labour codes on corporates, job creation and the economy. Coming up.
Welcome to a very special Indianomics. The 4 new labour codes notified by the government last week are a huge exercise in simplification. They reduce 1,228 sections to just 480, 1436 rules to just 351, 31 returns, and that's very important, 31 returns that companies have to file to just 1, and 4 licenses to just 1. It has, of course, other employer-friendly rules. For instance, it decriminalizes 65 sections, and it has employee-friendly rules like the eligibility of gratuity after just 1 year of service. There's much more, which is, probably well known. But to discuss the implications, I have with me an elite panel, but we are going to discuss 2 very different and specific issues. One, can it help more job creation, which is an economy question, and 2, a very legal question, how does it impact listed companies because of the new gratuity rules, which has to be calculated on 50% of the C2C and not just basic? Joining me are Manish Sabarwal, the founder of TeamLease, Amit Basole, professor at Azim Premji Institute, Somraj Roy, the CHRO, Chief Human Relations Officer at CIAT, and Atul Gupta, partner, Labour and Employment Practice at Trilegal. Gentlemen, good morning, and thank you very much indeed for your time. Deeply grateful to Manish, who has had to, who's just landed from a flight, and to Atul Gupta, who has put off a flight. Thank you, gentlemen. Manish, first to you. Give us the macro implications. Do you think small-scale enterprises are the ones that are benefited most?
I mean, the 5 victims of India's labor laws have been MSMEs, they have been backward states, they have been women or labor market outsiders, and they've been farmers, right? The most embarrassing number about India 35 years after reforms began in 1991 is that 45% of our labor force is still on farms. The only way to help farmers is to have less farmers. You can't make farming viable with almost half your labor force. But the high-wage non-farm job creation in India has been limited, muted, and disappointing. And I think infrastructure, skills, and finance have shifted from being a dagger in the heart to a thorn in the flesh, right? They need to get better, but they have improved substantially in the last 35 years. But I think regulatory cholesterol, and a big emblem of that was labor laws, there's a lot other things, is possibly the only explanation why 35 years after reform, in the same period, China has moved 300 million people from farm to non-farm employment. I know I don't want to live in China, but I do admire them moving, 400 million people from farm to non-farm employment. So I think labor laws have held back India in various ways, but they have held back employers. There is no other explanation for 63 million enterprises translating only to 30,000 companies with a paid-up capital of more than 10 crores.
Oh, yes, that's extremely well put in terms of numbers. Coming back to you, Manish, we'll handle the macro question and do the micro question as well of gratuity. Amit, first thoughts from you. Are you convinced, as an economist who concentrates on employment a great deal, that this is clearly liberalizing or liberating India's MSMEs?
So thanks, Lata. It's definitely a very big step, right? It's one of the biggest things we've seen in a while, especially in this field. Now, when we talk about labor laws, you're always balancing 2 things: the rights or protections for workers and making employers competitive. And economics, going back to Adam Smith, we know that employers are in a more dominant position. That's the way the economy works. So the state has to step in to protect worker rights. I think everybody agrees on that. The question for a country like India always is, when you have so much surplus labor and so many workers competing for the same few jobs, how do you enable more job creation? And that job creation will then make the laws more easy to implement. Yes. I think this is the really key point here, and the vision behind the laws is that implementing labor laws when there's a lot of surplus labor in the economy is very difficult. It's very easy for employers to work around those laws because there are workers willing to take up jobs. So tightening the labor market is really critical. Job creation is really critical to enable laws to function. And this, I think, is a vision here. So when we talk about things like fixed term employment, the new things they've introduced, hopefully we can talk more about that a little bit later, or allowing women to work in night shifts, or raising the ceiling from 100 to 300. nationally for the industrial disputes and so on. These are all ways to hopefully enable employers to become more competitive, expand, and create jobs. I say hopefully because many other factors matter. Okay? This is a supply side reform. Demand matters. Whether the investments will come or not, that depends on many other factors, infrastructure, logistics.
Absolutely.
Labor is not the only issue.
Yeah, no, I take your point. Technology, staring us in the face could be a, job destroyer. In fact, Amit, Manish, I spoke to, it is easy to get big corporates to speak. I had to, struggle hard to get a lot of SMEs, and their single point was life is much easier. ये जो नंबर 2 का काम करता है कैश का, वो लोग तो करते ही रहेंगे, लेकिन हमारे लिए the ability to compete with these informal guys is much better because, as Manish says, the regulatory cholesterol is much less. We have to spend much less time. The small industries are genuinely happy. I can tell you that. Will you create more jobs? I asked them. They said, "Arey, that will depend on our orders." No. All we are saying is life is easier. But they did not commit that they will be able to create jobs immediately. Now, with that, let me come to the formal sector big question, and then I come back to both of you for the economy questions. Somraj Roy, the big question that almost all the big corporates threw at me was, our gratuity bill will go up. Is that your worry as well?
Thanks, Lata, to have me on board. Look, we are still awaiting certain clarifications on various inclusions and exclusions of the wages. Whatever it seems from whatever I have read, the base for calculation of gratuity is to be upwardly revised. And that would mean there would be certain employee costs going up when gratuity base increases.
Okay. Now, let me put that to Atul Gupta as well. Atul, what is the legal position? There are many companies which say that 20 lakh is the maximum gratuity. I'm not going to pay more than that, and I'm not affected by the new law, which says that 15 days of last pay, basic pay, but not now going to be calculated as 50% of C2C, not just basic. So they are saying it doesn't bother us because our cap of 20 lakh helps. But there are yet other companies, and one of them has written in detail to me, saying that it is important to note that the new labor codes include a specific non-reduction clause. Any existing benefit cannot be reduced. And they also go on to say that companies like ours operate through an approved gratuity fund whose trust deed and rules clearly specify how gratuity is to be calculated and disbursed. Once established, these rules cannot be changed. So they are very clear that gratuity bill goes up as they understand the law now. Your point. You're on mute. Yeah, Atul, go ahead. No, we can't hear you, Atul. Okay, we'll come back to you, Atul, as and when we can get your audio, because this can increase costs and therefore lower earnings in at least the first year. Now, Manish, since you also run a company, what's your fear? Is this fear of corporate India legitimate?
I mean, in a cost to company world, all benefits come out of salary. They're not over and above salary, right?
Okay.
This is a myth which, Haath wali salary versus chitti wali salary is a myth perpetuated by people in government where benefits are not counted as part of employee cost. So I think that, yes, there may be some transition cost, but over time, we will just include the higher gratuity or whatever benefits the government may prescribe as deductions. I think, we are already the world's highest gap between Haath wali and chitti wali salary. It can go up to 42% for low-wage employees. I don't think people can live on 68% of their salary. So I think that this notion that the government can sort of treat obesity by mandating small sizes. We need higher wages through higher productivity employers. Issuing regulatory creating regulatory cholesterol that somehow people believe raises wages, it doesn't. We raise wages by raising the productivity of our firms, our sectors, our cities, and our individuals.
No, your point is absolutely correct for the bottom of the pyramid, where, it becomes formal. The problem that big companies have, especially old companies which are in existence for 40, 50 years, they have quite a few employees whose gratuity goes well above 20 lakh. And now it will be double almost because the basic pay becomes 50% of C2C. So, Atul, can you rewrite the policy midway?
Yeah, thanks. Thanks, firstly, Lata, for having me over. I hope you can hear me now.
Yes.
Yeah, so there's a lot to unpack here, right? Organizations have to contend with not just the new codes, but also a new definition of wages. Now, there is a common misconception in the market that basic pay has to be at least 50% of the gross. That's actually not an accurate reading. What has happened is that the definition of wages has changed. And under the old law, gratuity was paid only on two components, which is the basic pay and dearness allowance. Under the new law, the definition has expanded, and other guaranteed allowances could also be counted towards the calculation of gratuity. It could be even more than 50%, number one, right? Now, to your question of whether or not I have the ability to limit gratuity, yes, the old provision from the law, which has been repealed, has found its way into the new codes as well. There is an ability to now cap gratuity payments as before. The current limit of 20 lakhs still continue to apply, subject to any future notifications from the government.
Okay. Okay.
Right? The other issue that you raised
the point is even if that 20 lakh cap is there, many companies are not respecting that cap. They are paying ex gratia, which is taxed. Now, that ex gratia is suddenly doubled for a section of employees. So can they change?
Yes. So I don't think there is anything in the law which expects organization to continue to pay uncapped gratuity infinitely. Organizations will have to do an impact assessment to see how much their gratuity bill is increasing by and whether or not that's something that they can continue to budget for. If not, I do anticipate and I don't see a legal bar in organizations capping their gratuity payments and grandfathering the accrued benefits for people who've already accrued a larger sum, but going forward limiting gratuity amounts to the legal limit.
Okay.
Right, which is currently 20.
Got it. Which means a one-time hit as and when the rules are notified is possible. I want to check that with Somraj. Have to take a break. Back in a minute with more questions.